Okay, different video format this time. This is the beginning of a series I'm calling, Price Action 101. And so we'll start with an overview of price action analysis today. I'll try to keep these videos to 10 minutes each. We'll see how many, we need. But we'll try to start today with just really basic fundamentals. So if you think you understand how to read a chart, maybe this isn't for you. Maybe you want to listen to understand a slightly different perspective. But I want to kind of set a foundation. My previous, all the other videos on this channel, you'll notice just kind of jump right into it, assuming you already have some sense of of price action analysis. People also call it technical analysis. I'll talk about that a little bit. But think of this as your kind of starting point. I'll add some subsequent videos. I'll also make this a playlist so it's easy to see each video. I think you'll want to rewatch these. And if you like this kind of content, please let me know. If you have comments, feedback, just leave a comment in the comment section. I'll be sure to try to get back to you. So let's jump into it. So first off, what the heck is price action analysis? It's trying to understand where the direction of prices. And when I say prices, I mean asset prices. So that's everything from like a stock, commodity, ETF, pretty much anything that trades on an open market. And so the question we have to ask ourselves is what moves asset prices, right? Why is a stock $10 today, but $10.20 tomorrow and, $11 the next week, or moving in the opposite direction, for instance, as well. And it's really simple. It's supply and demand. When there's a lot of demand and there's a little bit of supply, prices increase. It makes sense intuitively. If there are a lot of people that are trying to buy a thing and just a little bit of that thing, the price tends to increase. And the reverse is true. If there isn't a lot of demand, no one wants to buy the thing, you'd have to offer it at a lower and lower price to get people to be willing to buy it. So that's essentially what's happening in the stock market every single day. But who is driving that supply and demand? Well, it's large buyers and sellers. It's really simple. I have a picture of Warren Buffett here just for illustrative purposes. Obviously, that's just, there are a lot of bigger players in the market. In a lot of cases, they're really institutions. It's not like an individual. It's like a pension fund, right? You've got hundreds of thousands, maybe even millions of people who have contributed to their retirement. That fund is making decisions on behalf of all those people. It's controlling billions, in some cases even trillions. And so when those large players are selling a lot of shares, that's going to make prices go lower because they're increasing the supply, assuming there isn't enough demand, like people that want to buy it to keep the prices up, right? If you have a huge seller without a huge buyer to absorb all that selling, prices are going to go lower. And the same thing goes in the opposite direction. You have a huge buyer, not enough supply in the market, that buyer may be willing to pay higher and higher prices to acquire, the stake that they were trying to acquire. So to use some real world examples, these numbers are very outdated because I put these slides together a while back. And the market is in the middle of a meltdown now. So these market caps are a lot lower than they are now, or they are a lot lower now than they were at this point. But to think about, this was, I forget which quarter, every quarter Warren Buffett's firm, Berkshire Hathaway, releases its holdings. So you can just download an Excel spreadsheet. I think you might have to copy paste it and do a little bit of quick formatting to get it into Excel. But all the same, you can literally see every single company in his portfolio, or I should say the firm's portfolio, how many shares do they own, when did they buy them, like all those details. So just looking at four of his bigger holdings, he owns Bank of America, 1 billion shares, right? Those billion shares worth 44 billion because at the time the stock was $44. I think like everything else, it's been taken to the woodshed. So this stock is probably like in the 25 range would be my guess. And the days to sell number here is an important one. So every stock has an average number of shares that change hands every day, right? Like in most cases, it's millions, right? So like, a stock might trade, a stock might have 1 million shares trade hands every day, which means if you wanted to buy 1 million shares, you obviously wouldn't be able to buy those 1 million shares in one day because there are only on average 1 million shares being sold and bought and on any given day, if that makes sense, right? So in that scenario, you would need to make your purchase over several days to not disrupt the market, right? So maybe you would plan your purchase over 20 trading days. So every day you buy 50,000 shares, right? So by the end of the 20th day, you've acquired your million shares and you haven't impacted the market as much because you're only buying 50,000 shares a day, but there are a million that trade. And so this is the same example here. These are real numbers. So because Bank of America only trades millions of shares a day, and Berkshire Hathaway owns a billion shares, it would take them 28 days, and this is just like the minimum number of days. It actually take them many more days, but it would take them at least 28 days to sell all of their shares, given the amount of volume that trades on a given day. And this 12% just represents the percentage of the company that he owns. So at the time, he owned about 12% of the whole corporation. So the same thing for all of these. He owns 400 million shares of Coca-Cola. He owns about 9% of that company. It would take about 30 days to sell. Kraft Heinz, American Express. American Express would actually take 53 days to sell because he owns so many shares. And so few shares trade per day. And so the point here is, if Warren Buffett, if the firm woke up one day and decided they wanted to get rid of their Coca-Cola stake, they would be selling for weeks and weeks. It wouldn't be a one-day thing. And so that would create price pressure. Remember the supply and demand I talked about? That would create a ton of supply. And so unless some other big player or a lot of players wanted to, didn't step in to buy those shares, that price is likely going to go lower over those days. And that's why, as we get into this series, you have to think about that. It's like, this stock has been down all month. Well, it's probably because it's being sold by a lot of institutions. A lot of them are trying to get out of their stake. And again, these things don't unwind in 1 or 2 days. In many cases, they need to sell for weeks in order to get out. Because think about it. So Warren Buffett has a billion shares. Let's say he paid $30 per share. So he paid $30 billion and it's now worth 44. They want to get out at the best price possible. So they want to sell while the market, they want to sell into rallies. And we'll talk about that as we look at downtrends. And again, these are all important things to keep in mind as you think about why something might be playing out the way it is. And so when people think about technical analysis, like this is the like definition that you'll find on Google. It's a trading discipline employed to evaluate investments and identify trading opportunities and price trends and patterns seen on charts. Technical analysts believe past trading activity and price changes of a security can be valuable indicators of a security's future price movements. So that's your definition from Investopedia. I think it's BS. I think that's why I don't even love the term technical analysis. I think it's a bit of bullshit. This is what people tend to think of when they think of technical analysis. You got all these indicators and it's like, oh my God, we've got all these lines. I think this is exactly the wrong way to do it. I think you should be keeping it simple. I think you need to think about those principles of supply and demand. How do we identify when there's a lot of selling pressure? How do we identify prices at which that selling pressure might dissipate, right? When is the seller done selling and we may get sort of more of an equilibrium in price? A lot of people think they're going to get these from these indicators, and I'm not saying they're useless or worthless. Just this to me is a lot of noise, and I like to avoid adding confusion, and I try to get to more signal, less noise. And so I focus on OHLC. That stands for open, high, low, close. On any given time frame, let's use a daily for instance, the market has an opening price, right? So there's a price that the market opened at today. We know what that price is. That price will never change. It's the price where we opened, right? At some point throughout the day, we're going to get to the highest price we'll ever get to in a day. At some point, we'll get to the lowest price we'll ever have. And then finally, there's the close. And so this is what price action analysis analyzes. Theoretically, this is what technical analysis should be analyzing as well. I think sometimes people get a little lost in Fibonacci's and triangles and head and shoulders and all this other crap. I try to focus on OHLC. And to put a finer point on it, you can analyze this data in Excel as well, right? That's your open, that's your high, that's your low, that's your close. This is your volume, which is another important thing to understand. And so the same data that you see in a chart like this, and we'll talk about what these are, these candlesticks, that's just this data here represented in chart form. So you're analyzing data. The chart is just presenting it to you in a different format. Because for a lot of people, this is not very, this doesn't necessarily, patterns don't just jump out to you when you look at this. This is more for a computer to process. But understand those charts are taking in this raw data and then giving you a visual representation. Incredibly important to understand that. And that's why, again, open, high, low, close is so important when you're looking at a chart. And so price action analysis is what we want to focus on. Price action being the movement of prices relative to each other. I'll be even more specific, and it's really the interplay between open, high, low, and closing prices on different time frames. Those create different probability outcomes, and so we'll talk more about that. And so this is not about fortune telling. We're not predicting the future. We're not making forecasts. I think this is going from $7 to 10. That's not what this is about at all. It's actually about probabilities. What is the percent chance that this happens versus that, right? Is there a higher percent chance of one outcome versus another? And depending on how high a chance that is, that tells you how much money to put on the line, right? If you have a 60% chance of success, that gives you that's better than 50-50. And so you can use that information to understand how much should I be willing to risk, and over time I should expect to have a positive outcome if that 60% edge holds true. And the price action analysis, folks, is the edge. And we'll get to that. It'll be several videos. So please, I ask you for sort of patience. We're gonna get to that, but that's the goal here. This is about probabilities, not predicting the future, not fortune telling. And so in the next video, we'll start to talk through how to actually look at a chart.